Investing in stocks is never as simple as it might seem. The concept of risk versus reward plays a critical role in deciding which stock to buy, especially during market corrections. In this video, we'll break down the risk and reward analysis for 3 specific stocks using practical examples. These examples will help you understand how to evaluate stocks in a correction phase and decide if it's the right time to buy. Welcome to Money Ocean, where we explore finance, making money, and the stories of successful people. Today's episode is all about whether it's time to buy stocks during the market correction. Let's dive into the video. Before we dive into the analysis, it's essential to grasp the concept of risk versus reward. This concept is straightforward. The higher the potential reward, the higher the risk usually is, and vice versa. But how do you apply this concept in real-life stock investing? Let's look at some hypothetical scenarios. Imagine you are considering 2 stocks. Both are expected to give a 10% return in the next 3 months. However, stock 1 has a risk of falling by only 2%, while stock 2 has a risk of falling by around 5%. Naturally, most investors would prefer stock 1 because it offers the same return but with less risk. But what if the situation is reversed? What if both stocks have the same risk of falling by 5%, but stock 2 has an expected return of 10%, which is twice that of stock 1? In this case, stock 2 becomes more attractive because it offers a higher reward for the same level of risk. This brings us to the crux of the matter. When analyzing stocks, especially during market corrections, you need to balance the potential rewards against the risks. To better illustrate this, let's dive into 3 real-world examples. Stock 1. Geo Finance Limited. Geo Finance Limited is a financial services company. To assess whether it's a good investment during the current market correction, we'll first look at its potential rewards and risks. Geo Finance hit a high of almost $395 on April 23rd. However, the stock is currently trading at around $329. The hypothesis here is that the stock could potentially climb back to its previous high of $395. If it does, this would represent a 16.5% gain from its current price. On June 4th, the stock experienced significant volatility and dropped to a low of $307. If the stock were to drop back to this level, it would represent a 7% decline from its current price. So the risk-to-reward ratio here is 7% risk versus 16.5% potential reward. This might seem like a good deal, but there's more to consider. Beyond price movements, it's crucial to examine the company's fundamentals. Geo Finance has seen foreign institutional investors, FIIs, reduce their stakes from 19.83% to 17.55%. This selling activity is partly due to broader market corrections driven by global economic concerns. However, domestic institutional investors, DIIs, have been buying, suggesting confidence in the stock's long-term potential. A significant concern for investors might be Geo Finance's high price-to-earnings P/E ratio, which stands at around 130. While this might seem excessively high, it's important to note that the company's income primarily comes from interest earnings on investments. Once Geo Finance's various business operations start generating operating income, the P/E ratio might become more relevant. While Geo Finance offers a favorable risk-to-reward ratio, the decision to invest should also consider its high P/E ratio and the recent FII selling activity. Investors should also be prepared for potential volatility in the stock's price. Stock 2. Bank of Baroda. Next, let's analyze Bank of Baroda, one of India's largest public sector banks. Like Geo Finance, we'll examine its potential rewards and risks. On June 3rd, Bank of Baroda's stock reached a high of around $300. Currently, it is trading at $240. If the stock were to climb back to its previous high, this would represent an 18.84% gain. The stock recently made a low of $231 on June 4th. If it were to fall back to this level, the potential downside is about 5%. This gives us a risk-to-reward ratio of 5% risk versus 18% potential reward. Bank of Baroda has demonstrated strong financial performance over the past few years. Its profits have more than doubled from 2022 to 2023. The bank's loan book is also well diversified across retail, corporate, agriculture, and infrastructure sectors, reducing its exposure to any single sector. Moreover, the bank has seen a reduction in bad loans, gross non-performing assets, and net non-performing assets in the recent quarter, which is a positive sign. The company has also achieved a healthy deposit growth of 8.9% and loan growth of 8.1%, further indicating its robust financial health. Bank of Baroda is projecting a growth rate of 13.5% over the next 5 years, which is quite promising. The stock is currently trading at a P/E ratio of 6.64. Much lower than the industry average of 9.46. This suggests that the stock may be undervalued, offering a good buying opportunity. Given its strong financial performance, diversified loan book, and attractive valuation, Bank of Baroda appears to be a solid investment during this correction phase. The risk-to-reward ratio also supports this view. Stock 3. Intellect Design Arena Limited. The third stock we'll analyze is Intellect Design Arena, a global fintech company specializing in banking technology. Intellect Design Arena reached a high of $1,200 on March 15, 2024. However, the stock is now trading at around $938, representing a 22% decline. If the stock were to recover to its previous high, this would represent a 22% gain. On June 4th, the stock hit a low of $816. If it falls back to this level, it would represent a 14% to 15% decline. Here, the risk-to-reward ratio is 14 to 15% risk versus 22% potential reward. Intellect Design Arena has a strong global client base, with many leading banks as its clients. Over the past 3 years, the company's revenues have grown by 19%, while its profits have grown by 8%. This performance is comparable to Oracle Financial Services, a key competitor, which has seen similar profit growth but lower revenue growth. The company's order book has been growing consistently, which is a positive sign. However, the recent revenue decline despite a strong order book is a concern that needs further investigation. The company's valuation also suggests caution, with a P/E ratio of 42, higher than the industry average of 35, and the price-to-book P/B ratio of 5.26, also higher than the industry average of 3.70. While the stock offers a favorable risk-to-reward ratio, its recent quarterly performance and high valuation suggest that investors should be cautious. It might be wise to wait for further clarity on the company's future earnings before making an investment. In this video, we've explored how to evaluate stocks using the risk versus reward concept during a market correction. Geo Finance, Bank of Baroda, and Intellect Design Arena each offer different levels of risk and potential reward. While all three stocks have potential upside, it's crucial to perform a thorough fundamental analysis before making any investment decisions. Remember, The stock market is unpredictable, and there are no guarantees. Always do your research and consider consulting with a financial advisor before investing. That's it for today's episode of Money Ocean. Thanks for joining us. Subscribe for more tips, analysis, and success stories. See you next time.